we're going to focus specifically on analyzing cash flow inside your business. This is one of the biggest misconceptions, that if there's profit, there is positive cash flow. Now, believe me when I say this, if you don't have profit, cash flow is not sustainable unless people are willing to continue to invest in a company that is not earning a profit. So cash flow is super important and it's driven by profitability, but they do not always equal. So we want to have a good understanding of how that works. So the first thing I want to pull up is a little document here that I have that I want to show you the difference of what impacts cash coming in and what maybe impacts cash going out at the same time. So in here, we've got a document that says net income from actual results of $50,000. This is where many of our clients come in, they have a net income of $50,000, but they have no cash left. One, to pay their tax bill that they owe because they made $50,000. And two, they're not understanding where all their cash went if their company made money. So what we're gonna look at is a few different ways that you can add positive cash flow to your business. And we need to understand this when we do our monthly financial cash analysis. Very first thing, if we have amortization or depreciation during the month, we need to add this back. Why? It's a non-cash expense. When we have a regular reoccurring depreciation or amortization expense, it doesn't cost you any cash out of your pocket. And again, this is what we want to try and compare when we're looking at net income to cash flow. What items have impacted net income that don't impact cash, or vice versa? So the very first one, amortization, when it's on there, we want to add it back because it's a non-cash expense. If we have a decrease in accounts receivable, that's going to increase our cash, right? It's not an extra sale. The profit was recorded in a previous period, but we've collected the money that people owe us. That impacts our cash, not our profitability. So a positive there. If we decrease our inventory, meaning that we've taken $10,000 in inventory and we've sold it all, yes, we've sold it, it's impacted our profit, but it's also going to help our cash flow. Increases in accounts payable. So what this means is we've expensed something in our business. The expenses come in here, we've expensed it inside the profit, we can see it's deducted, but we haven't paid any cash for it yet, maybe because we're financing it, maybe because we owe it next month. So because we haven't actually paid for it, it's helping our cash flow. So when we're thinking of this, this is where people talk about accounts payable management. If we increase our accounts payable and we hold off on paying it, it will allow us to earn the income and profit from our operations and avoid it going back out the door to pay our accounts payable. Same with increasing taxes payable, same as accounts payable, although we're specifically dealing with taxes. Yes, we may have a tax expense that's come into our net income, but maybe we haven't paid it just yet. So we can add that back to our cash flow until we actually pay that expense out. Then we will recognize it as an addition to our cash flow or an addition to the net income because we've expensed it and not paid it. The other area that would add to our positive cash flow would be any financing we receive. So if we think, for example, we own a building and it's worth $500,000, it's got a mortgage of $100,000 on it, we could then refinance it, pull the mortgage up to $200,000, pull that extra $100,000 of cash into our business. That has nothing to do with any of the net income or revenue and expenses inside the business. It's purely just refinancing, adding financing to our liability section and pulling in that extra $100,000 of cash. So on the opposite side, right, if we've got profitability, but we're maybe spending some of the money or paying bills from the previous period. So the very first thing that we would look at that would subtract from cash would be when accounts receivable go up. As our accounts receivable go up, it has a negative impact on our cash flow in our business. We need to understand that because so often when we start financing our customers' purchases for them, we're paying all the expenses related to it. So we're essentially financing the costs related to them using our services. Another area that we need to focus on is inventory. So think of yourself as a car dealer. You've got 2 cars on your lot that you're selling, and now you add an extra 10. So now you have 12 cars on there. Those are not expenses to your business because you haven't sold them yet. So as your inventory goes up in value, in number of items, it just means that you've had to spend the money to get those there, right? So we need the cash to buy the inventory, which means it's not getting expensed, but it's getting added as an asset. but it does cost us the cash. So again, we want to subtract from cash any of the increases in inventory. So in your business, if your inventory is increasing, you need to be conscious of this, that it could be draining your cash resources. Accounts payable. When your accounts payable go down, so when you've had expenses that you put in your profit and loss in previous months, but now you're actually paying them off, you're paying the vendors off in that period where you're paying them off, that is going to subtract from your cash, and it does have a negative impact on your cash flow. So again, on a monthly basis, we should be looking at our accounts payable and making sure that our accounts payable don't continue to go down to zero from a larger number, because it will drain our cash resources. Asset purchases. One of the biggest issues I see inside business from a cash flow standpoint is that they go out and they pay cash for assets. Great example, a lot of contractors, when they're starting to build up their fleet, they go out and they pay cash for their next vehicle. Another area that we need to be conscious of, yes, financing can help support growth. Yes, having access to a safety net is a good thing, but if we continue to maximize the debt that we're utilizing inside our business, what happens is at some point we have to pay this back. So again, in this business, we made $50,000 of income, but we might have a $10,000 loan repayment every single month. That means that $10,000 is going to come off that 50, and we now have access to $40,000 in cash. So again, any debt repayment does not count as an expense. It only goes and utilizes some of your cash resources. And the last one I want to touch on is shareholder payments. So a lot of time, business owners are pulling dividends out of their corporation. When they do that, it doesn't show up as an expense inside the business. It actually shows up as a loan receivable from the shareholder until dividends are issued. So what happens here? The company makes $50,000, the shareholder takes 10 of that, the company now has $40,000 left. Again, that's where net income is 50, cash flow is 40. That's how this continues to work. When we look at this specific example, guys, we start with a net income of 50. We've added $35,000 of cash into the resources inside the company. That would put us up to $85,000. But we've then subtracted from our cash all of these changes in our working capital and our debt repayments. So we've actually spent $141,000. This puts us at negative $56,000 in our business. That is a very dangerous position to be. We're not managing our cash resources very well, and the company could then be in jeopardy of not being sustainable for the future. I want to flip over here and show you an Excel document that shows and outlines the exact same thing. So in here, we've got January as an example, and guys, you can use this. This is here for you to maybe chart out your cash analysis on a monthly basis. You can continue to add lines into additions to cash, continue to add lines into subtractions from cash. This will give you a really great detailed analysis of what's happening to your cash flow. So the exact same numbers in here, we're starting with $50,000. We then are adding to cash amortization, it's a non-cash expense. Our decrease in inventory, we're selling inventory off, that's helping our cash. Our increase in accounts payable, that means we've expensed things that we're not paying for, that's helpful. And we received $10,000 of financing. It's $35,000 addition, right, to our cash flow. That puts us at 85 to start. And then we have our $100,000 increase in accounts receivable. We sold something for $100,000, but we didn't collect the cash. That is detrimental to our cash flow. We have to subtract that. Any increases in inventory, we have to subtract it. Decreases in accounts payable, so paying off previously expensed items, we have to subtract that. Asset purchases, like I mentioned, buying a new vehicle for $10,000, that's going to decrease your cash resources and not be an expense on your profit and loss statement. Debt repayment, so repaying $1,000 a month on your mortgage of your building, that is going to be reducing your cash resources. And pulling money from the company for your own personal use, again, your business is your own business, but if you take all the cash and you drain it out, there's nothing left to reinvest or to grow your team, your resources. And if you have a month where you increase your sales by $100,000 but don't collect any cash, you can see what happens here. This company is in a very negative cash flow position, negative $56,000 for the month. not a very sustainable model. We need to figure out how we resolve that in February. So again, as part of your monthly financial analysis, you need to understand what's happening inside your cash flow. Make sure that you take your profit and loss or your income, your net income, you start it in here and you start adding and subtracting any of the adjustments to your net cash flow. This will help you understand not only what's happened in the past month, but what will impact your cash flow in the future, which will be super beneficial to helping to create a long-term sustainable company that can reinvest in growth and realize extraordinary long-term financial results.
Thank you for watching the video. To get access to the worksheet that we included in this session, click on the description below and download the document. This is a document that we use to help individuals plan out how to accomplish their $1 million year, and we want you to have access to it. Hey there, thank you for watching this video. If you like this video, make sure you like it, you leave a comment, share it with a friend, and make sure you hit subscribe to catch more videos just like this. And for all you ambitious entrepreneurs who are looking to start scaling your business immediately, make sure you check out the resources that we've included in the description below. We've got a link to download your digital copy of my best-selling book, The Wealthy Entrepreneur. That will give you so many tips and guidelines on how to scale your business starting now. And last, but definitely not least, if you're excited and ready to get started today, there's a link to book a session with our growth mindset expert to start achieving your $1 million year starting now. Remember, being a business owner isn't easy and not everybody understands it. But in the right community with the right strategy, you can accomplish your $1 million year and achieve financial freedom starting now.